Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. The JOLTS data did jolt the dollar bulls, but what is the JOLTS data which everyone is tracking? It's called the Job Opening and Labor Turnover Survey. It tells us how many job openings there are each month, how many were hired, how many quit, how many were laid off. It's an important indicator of labor demand, which came in much lower than expected yesterday. This was not the only negative dollar data, but even the US consumer confidence fell for the month of July. Good morning, JK. We are finally seeing some respite in the dollar strength. How are you reading these data points? Keen to hear your thoughts.
Hey, good morning, Swaraj. Happy Raksha Bandhan Day to everybody. The JOLTS data really jolted the market out of its slumber yesterday. And while generally there was an expectation that the numbers would be weak, but I think it came much weaker than most expected. And it printed sharply below the forecast. The important thing is even the quit rate is falling, which means that people are hesitant to quit jobs and not so confident of finding alternate jobs. That is exactly the situation what the Fed wants to see, so that the demand side of the inflation is moderated. And what followed was also the consumer confidence number that was also disappointing. A bigger than expected slide with lower revisions to the prior month, and the employment component also showing weakness. So the yields obviously, it took a big tumble after the data, and broke through several. Actually, the bond prices broke through several resistances, and even the algo programs switched over to buy mode in the bond market. One of the biggest short covering trade in bonds that was seen in recent times. The gains were extended by the stellar 7-year note auction result that showed aggressive bidding and strong non-dealer participation as well. Now, what all this did to the future expectation was also significant. In the background of today's data, a sharp drop in the money market rates, as the economic reports will be welcomed by the Fed. OIS rates declined with the rate cuts moved up from July to June 2024. Fed Fund future odds for no hike in September shot up to 86.7%, with November odd now falling again to 45% from just about 50% that was seen yesterday. Now there is a 37% chance priced of a further hike by November, that is from 50 seen yesterday. About 107 BPS of cuts are priced in by the end of 2024. And once again, revised from 91 BP that was priced in earlier. Now, even before, even as all this was happening, we had some fiscal measures announced by two important, or rather two significant economies, China government, as well as the European, or rather the German government, which is the largest economy in Europe. There has been, talk of incremental policy changes in China, and more support for the banks lending, etc. That is, they are also preparing banks to cut interest rates on the existing mortgages in what would be a target to push consumer spending, and the latest efforts for the government to shore up the growth. While even the finance minister is hoping to support, rather strengthen policy support and speed up government spending as the economy comes under strain. So really some serious measures that is being contemplated and announced by them. Then we also had the German government. They overcame the political tussle and announced a package of tax cuts up to 32 billion euros in the next 4 years. And again, once again, to shore up the ailing economy. And this is mostly directed towards the corporate tax cuts, and also encouraging the green energy, which means huge investments and employment creation is what they are contemplating, and to target the consumption eventually. So all this was the much needed boost to the equity bulls. Stock across markets rose, Dow up 0.85%, S&P 1.45%, and Nasdaq an impressive 1.74%. And of course, the thin markets in the US ahead of the long weekend coming up exaggerated the moves, with absolutely no sellers around. The pan-European stock index was 0.97% up, and the global stock index was up a whopping 1.45%. Even the emerging market stock index was up 1.11%. So it's all around a very strong, benignly strong environment for risk yesterday. Of course, we have more data coming up, and that should be something, keep the market from going too exuberant. We have PCE core inflation number tomorrow, then the GDP estimate, second estimate of the GDP. Finally, more indications on the jobs data, ending with the NFP data on Friday. Now, on the yields, we had big drop in the 10-year and the 30-year yields. 2-year, of course, caught the maximum move with almost a 15 basis points fall from 5.05 previous year to 4.90. In fact, the low seen was 4.88 as well. With such a massive fall, one could not hold back the bulls in bonds, equities, and even precious metals in the currencies as well. In the currencies, the dollar was down 0.11% at 103.82, having seen 104.45 level reached in on Friday last. Now, Eurozone also saw some consumer confidence data from Germany that was weaker. So we had just before the JOLTS and the consumer confidence data, we had a setup where dollars getting again stronger. Euro was threatening to break below the 200 DMA at 1.0780, and dollar yen in fact broke the previous high and went as high as 147.45. But then the data brought down all these currencies, rather brought down, the dollar down to earth, and we saw the euro rally. In fact, the tax cut announcement in Germany aided the euro rally further, because then markets started taking some positive view of the German economy bouncing back, and the yield drop obviously brought the dollar yen against dollar also down against the yen below 146. Although now trades about around 146 levels now. Chinese one still in that 127, 130 range, not moving much. I think market probably expecting more out of it. Then it's surprise, but not. One cannot say it is totally illogical, because it's a yield dropping helped the precious metals higher. Gold and silver rallied yesterday, but their gold is now up at very important resistance near 1935, 1940. That is where it has stalled, but more data and showing weakness could just push the gold above 1950. But underlying support for gold is quite evident, because despite calls for it to test high 1850 and 1860, it has not even broken 1890 convincingly. So seems to be some solid buying emerging in gold. That the recent close and further drop in the yields could only spur a bigger rally. Rupee was a very quiet day yesterday. No selling was evident yesterday, because right from the beginning there was some talk of outflows from corporate. Oil buying was also evident. We pushed above 82.70, and in fact pushed closer to 82.80 in offshore trades just before the US data. But I think we're back to where we were trading at 82.60. But I think in Indian equities and the Indian economy is also looking at some of the domestic factors. The monsoon, obviously increasing talk about the monsoon being a failure toward the latter part of the season, and which might affect the rural demand. We also had LPG prices cut, a big demand out of the fiscal position of the government, and it's not yet clear how much it will dent the fiscal position. Obviously the thinking is whether we would be seeing more populist measures going forward as we head into the elections, and how it would affect the government's finances. So these are some things that the investors would be considering as far as the rupee is concerned. As of now, we can look at the positive impact of that, because the fall in price of LPG cylinders could bring down the inflation, headline inflation by a few basis points. So rupee, I think not much of an impact from these, because a mix of from domestic and global factors keep the rupee range bound for the time being. Good demand seen above 82.50, and only break below 82.40 should see more strength, and 82.80 obviously becomes a big resistance. Looking forward to more hectic days of sessions to come up for the markets before we break into the Labor Day weekend. Thank you.
Thank you, JK. And labor market conditions is something which Fed closely tracks. So JOLTS, which fell sharply, was already expected. Already a weak number was expected. So basically, quits number is coming down. People are hesitant to quit their jobs. All of this led to some impact in the markets. Yields fell sharply, 10-year, 30-year, and 2-year, which fell quite sharply, around 15 basis. And when it comes to the rate cut expectations, it has moved up from July 24 to June 24. And November rate hike probabilities also fell after yesterday's data. When it comes to other economies, Chinese government is already on talks of incremental policy changes and support for banks with respect to lending to boost consumption. Now, the upcoming data, which we would be closely tracking, is the PCE core inflation tomorrow, US GDP data, as well as the NFP on Friday. When it comes to INR, we saw no major selling yesterday, but oil buying and outflows led to some fall in the rupee to 82.70. So that's it from us today. Happy Raksha Bandhan. Hope you have a great time with your loved ones. Tune in tomorrow for fresh updates on the financial market. Thanks for listening.